ever dreamt of that perfect 100 out of 100 on the SAFE exam, we're talking absolute mastery, like every single concept totally locked in. If that sounds like you, then you're definitely in the right place. Welcome to the Deep Dive, the show where we take, a mountain of information, sift through it, and pull out those golden nuggets of knowledge.
Yeah, and specifically tailored for you as you're gearing up for this critical test.
Exactly. We get the pressure. We know the sheer volume of stuff you're trying to absorb.
That's right. And look, this isn't just a casual listen. It's really designed to be your strategic study session, your shortcut to feeling confident.
Right.
Our mission today is to dissect the absolute core of mortgage origination. We're talking application, underwriting, closing, the whole 9 yards.
And we're pulling directly from the source material you'd be using to prep, right?
Good.
Making sure we
Right.
have that textbook fidelity on every key definition.
And absolutely critical, verbatim where it counts.
And we promise we're not just going to recite facts at you. We'll break down the complex stuff, shine a light on those tricky areas that, trip people up,
Even experienced folks, yeah.
and deliver those key definitions with that exact precision, that textbook fidelity you need to absolutely ace the exam. This deep dive is about equipping you, the future top-tier loan officer, with every single detail you need to hit that perfect score.
We're your guides today. Ready to unpack what's truly important, connect those dots.
Yeah, the ones you might otherwise miss. And make sure you feel exceptionally well-equipped. Start right at the beginning. The loan's journey, the application process itself. This isn't just paperwork, is it? It's really that first impression with a potential borrower.
Oh, absolutely. It sets the whole tone.
Yeah.
And the foundational document here, the one you just have to know inside and out, it's universally recognized.
Okay.
As the source material puts it, quote, "The standard form for a mortgage application is the Uniform Residential Loan Application, URLA, also known as Form 1003, end quote.
Form 1003.
Yeah.
URLA.
Yep, that's the one. It's not just a formality. It's like the central hub for all that initial borrower and loan info.
Right. And its purpose seems clear. It's that initial gateway. It's designed, and I'm quoting here, to obtain the information needed to complete the loan application,
Makes sense.
which can occur face-to-face, over the phone, or online. So it's not just a static piece of paper anymore.
Not at all. It's pretty dynamic now, especially the digital versions. Adapts to how you're interacting with the borrower.
Okay. And while you, as the MLO, are guiding this, the borrower has a big role too, right? They have responsibilities from the get-go.
A huge role. The guidelines are crystal clear on this. Loan applicants must complete a mortgage application and provide documentation to verify the information's accuracy.
Okay, so completion and verification.
Exactly. It's not optional. It's core to a compliant loan process. Without accurate, verifiable info, you're stuck.
Now, timelines. The exam loves timelines. And there's a crucial one here for you, the LO. This sounds like a highlight this in your notes moment.
Definitely. Get your highlighter ready for this one.
The rule is, applicants must be notified in writing of their loan application status within 30 days of the application date, and this notification must be kept in the loan file.
That 30-day clock. It's serious business, and it starts ticking the moment you have what's considered a complete application.
What if info is missing? What happens then? Does the clock stop?
Good question. The clock generally keeps ticking on the overall decision timeline, but the onus is on the originator, on you. The source says you should notify the applicant immediately and allow a reasonable time to furnish it.
Immediately.
Don't sit on it. Delays here can cause real compliance headaches, maybe even regulatory fines. Prompt communication, diligent follow-up, absolutely critical for you as an LO.
Okay, moving on. Let's really deconstruct the URLA itself, Form 1003. Understanding its structure and maybe more importantly, what you can and cannot change. That feels vital.
Oh, it's huge. This is a high-yield exam area, definitely. Pay close attention here because this is where a lot of people get tripped up.
Got it. So the structure first.
At its core, the URLA has, quote, two main components. The borrower information component, filled out by the consumer, and the lender loan information component, completed by the MLO.
Borrower part, lender part, makes sense.
And of course, if you've got more than one borrower, there's that additional borrower component for the co-borrowers. Got to capture everyone's details.
What's interesting is the design. You mentioned it's intentionally similar to the loan estimate and the closing disclosure.
Yeah, that's deliberate. That consistency in look and feel helps consumers, right?
Right.
Reduces confusion during what can be a pretty overwhelming process.
Makes sense.
And it's also designed now as this interactive dynamic digital form.
Yeah.
It adjusts based on the input, which is, much more modern and user-friendly than the old static PDFs.
Okay, but here's the crucial distinction, the one that apparently trips people up: flexibility.
Ah, yes. This is key. Quote, unlike the loan estimate and closing disclosure, which are governed by the TRID rule and cannot be altered, the URLA is a flexible document.
Wait, flexible? You can change the standard application form.
Yes, but, and this is a huge but only, quote, within Fannie Mae and Freddie Mac's rendering options guidelines, there are strict limits to this flexibility.
Okay, so it's not a free-for-all. There are specific rules.
Exactly. Knowing this difference, rigid TRID forms versus somewhat flexible URLA is a key distinction for the exam.
All right, let's get specific. What are those acceptable alterations? We need to memorize these exceptions.
Okay, first allowance. Elimination of the additional borrower application and the unmarried addendum for single applicant transactions.
Makes sense. If there's only one borrower, you don't need the extra forms. Streamlines things.
Right. Second, you can add state-required disclosures on the continuation sheet.
Ah, so state specifics go on an addendum, not messing with the main form's layout.
Precisely. Keeps the core federal form standard, but allows for local compliance. Smart design.
Okay, what else? Presentation.
Yeah. Third, lenders have some flexibility in how they present the components. They can present URLA components combined or separately.
Combined or separate?
Okay. But if they do combine them, there's a recommended best practice the exam might touch on. Quote, the recommended order is borrower information, additional borrower if applicable, and lender information.
Borrower, additional borrower, lender. Noted. That order might matter.
Could be. Fourth, even small stuff like fonts. You can use different font styles with a minimum 8-point font recommended.
8-point minimum. Okay, readability matters.
And finally, to handle complex situations without needing a custom form every time, you can allow for repetition of subsections for additional employment or properties, and also expansion of sections for assets and liabilities.
So if someone has 3 jobs or owns 5 investment properties, the form can accommodate that.
Exactly. You don't just run out of space.
Okay, that's what you can do. Now the big one. What absolutely, positively cannot be changed. This sounds like a must-know.
It is. Absolute must-know. This is prime test question material. The source material is emphatic. The wording on the form, field names, descriptions of requested information, and section order may not be changed.
Wow. Okay, so wording, field names, descriptions, section order, completely off limits.
Totally off limits. That rigidity ensures the core info is standardized everywhere, consistent for regulators, investors, everyone. Don't touch the fundamentals.
Got it. Okay, shifting gears slightly. Let's talk about the serious side, that the borrower's legal and ethical obligations. Your role as an MLO here seems pretty significant.
It is profound. You have, quote, a responsibility to explain to applicants their legal and ethical obligations to provide accurate information.
So it's not just taking info, it's educating them on the importance of truthfulness.
Exactly. This isn't just filling out boxes. It's a legal and ethical commitment. And the consequences, if they don't meet that commitment, they're severe.
How severe?
The rules are unequivocal. Including false information on a loan application is a violation of criminal laws.
Criminal laws. Okay, not just a slap on the wrist.
Not at all. Significant legal ramifications. And the URLA themselves warns them directly.
Where's that?
Quote, Section 6 of the URLA includes an acknowledgement that intentional or negligent misrepresentation can result in civil liability and/or criminal penalties. It's right there, plain as day, before they sign.
And that warning links to a specific law, right?
It does. It references 18 U.S.C. Section 1001, the Federal False Statements Act. You should probably recognize that citation.
18 U.S.C. 1001, got it. What's the penalty?
A violation can lead to a 5-year jail term. And they define what makes a false statement material in this context. Quote, a false statement is material if it is intended to influence the recipient to grant credit.
So if the lie could actually sway the loan decision, it's material.
Precisely. That helps distinguish between, say, a typo and actual fraudulent intent. Crucial distinction.
But it's not just the borrower who's on the hook here, right? What about the MLO?
Good point. You, the MLO, also have significant accountability. You must also sign the application, verifying that all questions were asked and recorded properly, and indicating responsibility for their actions.
So you're vouching for the process integrity?
You are. You're accountable for ensuring the info collected truly reflects what the borrower told you.
And sometimes there's an additional warning, the FBI one.
Yeah, it's optional for lenders, but some include the FBI mortgage fraud warning notice. It states that mortgage fraud is punishable by, get this, up to 30 years in federal prison or a $1 million fine, or both.
Wow, okay. That definitely underscores the seriousness.
No kidding, it's a massive deterrent.
All right, let's do that section by section deep dive into the URLA's borrower information part, sections 1 through 8. This is where the real nitty-gritty details are.
Yep, knowing these fields, why they're there, what they capture, it's super helpful for the exam and just for doing your job well.
Okay, section 1, borrower information, the basics. 1A, personal info. What's key here?
Pay attention to the marital status options, specifically the definition of unmarried. It includes, quote, single, divorced, widowed, civil union, domestic partnership, etc. It's a really broad category.
Okay. Why is that broad definition important?
Because different legal relationships, like civil unions or domestic partnerships, can impact things like property ownership rights or creditworthiness, especially depending on state law.
Got it. Then 1B, 1C, 1D, employment and income. What's the main takeaway?
Stability. The key detail for qualification is that, quote, at least 2 years of current and previous employment and income must be provided.
That 2-year look back again, standard requirement.
Pretty standard, yeah. Demonstrates a stable, reliable income history.
Okay, section 2, financial info, assets and liabilities. The money picture.
Right. 2A is assets. You'll see specific financial instruments listed. You should probably know the difference between them. Like a money market account.
What's that exactly?
It's defined as a savings account with a higher than average interest rate, typically with a higher minimum balance and limited transactions. Better returns than checking, but maybe fewer withdrawals allowed.
Okay, and CDs.
Certificates of deposit, CD. A savings account with a fixed term and maturity date, offering a higher interest rate with penalties for early withdrawal. Money's locked up for a set period.
And mutual funds.
Also common. Mutual funds, an investment vehicle where funds from many individuals are pooled to invest in securities like stocks and bonds. Shows diversified investments.
Then 2B, other assets. What kind of things fall here?
Specific types you should recognize, like earnest money, that good faith deposit on a purchase.
Right.
Sweat equity, the value of labor someone puts into a property, maybe for a renovation loan. And relocation funds, money from an employer to help with moving costs. Knowing these helps build the full financial picture.
Okay. And 2C, liabilities. That's just debts, right?
Pretty much.
Done.
Standard stuff. Credit cards, installment loans like car or student loans, medical debts. Straightforward deductions from their financial standing.
Section 3, financial information, real estate. What properties do they own now?
Exactly. And here, the order matters for refinances. Quote, if refinancing, the property being refinanced must be listed first.
Ah, okay. Refi property goes first. What info are you getting?
Address, estimated value, ownership status, owned free and clear, subject to mortgage, and their intended occupancy, primary residence, second home, or investment property.
Got it. Section 4, loan and property information. What they're actually applying for.
Right. 4A covers loan purpose, property value, occupancy. And here's a critical distinction, especially for the FHA part of the exam. It often causes confusion.
Okay, what is it?
Manufactured versus modular homes. Remember this difference. It's a classic test question. Quote, FHA loans distinguish between manufactured homes, built entirely in a factory on a chassis, and modular homes, segments built in a factory, transported, and permanently assembled on-site.
So manufactured is built on a chassis, modular is assembled on-site.
Yes, and crucially, modular homes are treated as real property from the start. FHA views them very differently for lending purposes.
That's a key distinction. What else in Section 4?
4B, other new mortgage loans. This covers things like those subordinate piggyback loans taken out at the same time.
Okay.
And 4, gifts or grants. This asks about any funds for down payment or closing costs that don't need to be repaid, like from family or assistance programs.
Right. Section 5, declarations. This sounds like where potential problems might surface.
Exactly. It's designed to uncover red flags or significant history. In 5A, about this property and your money, it's vital to know that, quote, misrepresenting a property as a primary residence or failing to disclose secondary financing, a silent second loan, is mortgage fraud.
Okay. Definite fraud indicators. MLOs need to watch for those.
Absolutely. And in 5B, about your finances, you're asking about co-signing, judgments, delinquent federal debt, lawsuits, and importantly, any history of foreclosure, short sale, or bankruptcy within the last 7 years.
7-year look back for those major events.
Yes. And if bankruptcy is declared, you need the specific type, Chapter 7, Chapter 11, Chapter 12, or Chapter 13. This section is all about transparency regarding past financial events.
Okay, Section 6, Acknowledgements and Agreements. This sounds legally significant.
Extremely. The borrower makes 6 key legal commitments here. You really need to know these points for the exam, probably verbatim, as they detail legally binding agreements.
All right, let's go through them. Number 1.
First, the big one on truthfulness. The borrower acknowledges that, quote, the information provided is true, accurate, and complete, with an agreement to update it if anything changes before closing. It also reminds the consumer of civil and criminal liability for misrepresentation.
So they affirm truthfulness and promise updates. Makes sense. Number 2.
Second, they agree the loan is secured. Quote, the loan will be secured by a mortgage or deed of trust, giving the lender a security interest in the property. Clearly states the home is collateral.
Okay. Third, about the appraisal.
Yep. Quote, any property appraisals for the lender's use, and no representation has been made about the property's condition or value. Protects the lender, clarifies the appraisal isn't a home inspection for the borrower.
Got it. Fourth, records and e-signatures.
Right. Borrower acknowledges, quote, the lender may keep records regardless of loan approval, and the consumer consents to electronic records and signatures if applicable. Covers data retention and modern processes.
Fifth, credit reporting and help.
Yes. The agreement outlines, quote, the lender may report account information to credit bureaus, and defaults will be reflected in the credit report. The consumer can contact a HUD-approved counseling agency if they have trouble with payments. Reinforces consequences and offers a resource.
And sixth, information sharing.
Broad authorization here. Quote, the consumer authorizes the lender and other loan participants to obtain, use, and share the application, credit report, and tax return information as necessary to process the loan and for other permissible purposes. Allows necessary sharing to get the loan done.
Okay, those 6 acknowledgments are heavy hitters. Good to know them precisely. Finally, Section 8, demographic information.
Right. This is all about compliance with federal law, specifically the Home Mortgage Disclosure Act, HMDA. It, quote, asks for ethnicity, sex, and race to comply with federal law. The purpose is to help ensure fair treatment and that housing needs of communities are being fulfilled.
So it's for fair lending monitoring. Is it mandatory for the borrower to answer?
Good question. Providing the info is, quote, voluntary for the applicant. But, and here's a critical MLO duty the exam loves, if it's voluntary, you might think you just skip it if they decline.
Yep.
Right.
Seems logical.
Wrong. Quote, however, if an applicant chooses not to provide it during an in-person or video application, federal regulations require the MLO to note the information based on visual observation or surname.
Wow. So even if they opt out, the MLO has to make a determination based on observation or name.
Correct. It ensures the data is collected for HMDA monitoring purposes, even without self-identification. It puts the compliance responsibility squarely on you, the MLO. Critical point.
Okay. Beyond the main URLA, there are addendums too.
Yep. Supplemental forms. The additional borrower forms, obvious, just captures info for co-borrowers.
Right.
The unmarried addendum, which we said can sometimes be eliminated, is used, quote, when a borrower selects unmarried in Section 1 and state property laws affecting creditworthiness for relationships like civil unions or domestic partnerships need to be determined to ensure clear title. So it addresses specific state laws.
Makes sense. And the continuation sheet.
Exactly what it sounds like, just extra space if needed for any section. Pretty simple.
Okay, now let's flip to the other side of the URLA, the lender loan information component, sections L1 through L5. This is your perspective, the MLO's part.
Exactly. Documenting the loan-specific details.
Section L1, property and loan information. What's important here? Community property.
Yes, that's a big one. It's specific to, quote, 9 states, mostly in the West and Southwest, with different marital asset laws. The rule you must know for the exam is a credit report for the non-involved spouse must be obtained in these states, and their debts are considered in the DTI ratio of the borrowing spouse.
So even if only one spouse is borrowing, you have to pull the other spouse's credit and count their debts in the DTI in those 9 states.
That's the rule. It protects the lender against claims on shared marital assets. Very specific, very testable.
Okay. What about transaction detail? Things like contract for deed.
Yeah, that's an alternative financing method. A contract for deed or land contract. A financing arrangement where the buyer makes payments to the seller who holds the title until the price is paid in full. Basically, seller financing where title transfer is delayed.
And renovation versus construction loans.
Renovation loans like the FHA 203K let you roll repair costs into the mortgage. Construction loans finance building a new home, and they can be single closing, construction converts to permanent, or 2 closing, separate construction loan then a permanent one.
Refinance types. Beyond no cash out and cash out, there's a specific conventional one.
Yes, the limited cash out, conventional. It, quote, allows adding refinance costs to the loan and receiving cash back limited to the lesser of 2% of the loan amount, or $2,000. That specific 2% or $2,000 limit is key to remember.
Got it. And energy improvement loans, PACE liens, there was something about priority.
Ah, yes. This trips people up because it breaks the usual first in time, first in right rule for liens. Quote, PACE assessments are added to property tax bills and create a lien that has priority over mortgage lien.
Priority over the mortgage. Wow.
Yep. Means if there's a foreclosure, the PACE lien gets paid before the first mortgage. Huge for understanding risk.
Okay. Section L2, title information, how ownership is held.
Right. Estate type. Fee simple is the most common, quote, full unconditional ownership of property. Then there's leasehold where, quote, the homeowner purchases the home but rents the land it is built on via a long-term lease, paying ground rent. Own the house, rent the land. Big difference.
Manner of holding title, joint tenancy, tenancy in common.
Crucial distinctions, especially for inheritance. Joint tenancy usually has right of survivorship, passes directly to the co-owner, avoids probate. Tenancy in common interest goes to heirs via probate. Tenancy by the entirety, specific form for spouses, often protects from individual debts.
And trusts. What's the key thing for an LO there?
Knowing the types, especially irrevocable trusts, they're very hard to change. As a practical note, quote, many lenders won't process refinances on homes held in them because the trustee, not the borrower, holds legal title. Makes lending much trickier.
Good practical point. Okay, section L3, mortgage loan information, loan specific.
Yeah, amortization type, fixed arm, features like balloons, interest only, negative amortization, and a really crucial detail about temporary buydowns often confused on exams.
Okay, what's the rule for buydowns?
For qualification, lenders must qualify borrowers based on the note rate, not the blot-down rate.
Qualify on the full note rate, even if the initial payments are lower due to the buydown.
Exactly. Ensures they can actually afford the loan when the subsidy ends. Big compliance and qualification point.
All right, application's done, info captured. Now the real detective work begins, right? Figuring out if this loan actually makes sense.
Yep, for the borrower and the lender. This is where the underwriter comes in, armed with the famous 4 C's.
The 4 C's. Okay, let's break those down.
Underwriters systematically look at 4 main areas. First, credit their payment history, how responsible they are. Second, capacity, income, and debt, can they actually afford it? Third, capital their assets, do they have reserves, enough for closing? And finally, collateral the property itself, is it good security?
And while automated underwriting systems, AUS, do a lot now.
A lot, yeah. But that human underwriter's verification is still absolutely essential. Checking docs, ensuring accuracy is assessing the overall risk. AUS can't do it all.
Okay, let's dive into the first C, capacity, income and debt. The big question, can they pay?
That's the bottom line for capacity. It's mainly analyzed through debt to income, or DTI ratios, but it all starts with solidly verifying their income.
And that verification is mandated, right, by the ATR rule?
Absolutely key. The ability to repay rule requires that, quote, verification is required by the ATR rule using reasonably reliable third-party records.
Third-party records, so not just taking their word for it, what kind of records?
Things like IRS tax return transcripts, W-2 forms, payroll statements, financial institution records, employer records, and government records for benefits. Independent, verifiable sources are crucial.
What about the verification of employment? The VOE, Fannie Mae Form 1005, anything special there?
Yes, a critical compliance point. Exam favorite common mistake area. It's about fraud prevention. Quote, for first lien mortgages, the borrower may not deliver the form. The employer must mail it directly to the creditor.
Borrower can't hand carry the VOE, employer mails it direct. Got it.
Yeah.
Prevents tampering.
Exactly. Ensures the info is clean, straight from the source.
Okay, income documentation nuances. This sounds like a high-yield section for the exam. Overtime and bonuses.
Generally, not likely to be considered unless received consistently for at least 2 years and likely to continue. They want a proven track record, not just a one-off payment. Stability is key.
What if commission is a big part of their income, like over 25%?
Stricter rules apply. It requires copies of tax returns for the past 2 years and income is averaged over that period. Again, showing consistent earnings over time, smoothing out fluctuations.
Self-employed borrowers, I assume more documentation needed.
Definitely. They show maintain income for 2 years. Lenders will need tax returns for the past 2 years, a year-to-date profit and loss statement, and balance sheets. And income is also usually averaged over a 2-year period for a realistic picture.
Alimony or child support, can that count as income?
It may be used if court-ordered, and there's a stable history of receiving payments, typically verified for the past 12 months, needs consistency and a legal obligation backing it up.
And rental income from an investment property, say. Is there a special calculation?
Yes, a specific rule often tested. Underwriters use 75% of the stated rental income unless 1040s document a lower amount.
Only 75%. Why the reduction?
That 25% haircut accounts for potential vacancies, repairs, management fees, other expenses. It gives a more conservative, realistic estimate of usable income from the rent.
Okay, that 75% rule for rental income is important. Second C, capital. Assets. The question is, do they have enough to close?
Right. Enough liquid assets, primarily. Cash, checking, savings, things usually accessible. Non-liquid assets like other real estate or retirement funds count too, but they're harder to tap quickly.
And the verification of deposit, VOD, Fannie Mae Form 1006, same rule as the VOE.
Exactly the same principle. Another exam favorite. Quote, for first lien mortgages, consumers cannot hand carry the VOD form to their bank. The depository institution must send the completed form directly to the lender. Again, prevents tampering, ensures clean data direct from the bank.
Gift funds. Always a tricky area. What are the absolute must-knows here?
Okay, gift funds are great for borrowers, but require very specific documentation to prove their actual gifts, not disguised loans. You need a gifts letter, and it has 6 specific requirements you must memorize. Think of it like a checklist.
Okay, lay them out. The 6 requirements for a gift letter.
Got it. Quote, 1. A description of the relationship between the loan applicant and the donor. Who are they? 2. A statement that the gift funds must be used for a home purchase, purpose specific. 3. The address of the home that the applicant will purchase, links it to the property. 4. An assurance that the donor does not expect repayment of the funds. Crucial, no strings attached part. 5. Identification of the source of the funds and where did the donor get it. And finally, 6. The signature of the donor makes it official.
Wow. Okay, that's very specific. Relationship, purpose, property, no repayment expected, source of funds, signature. Got it. Any restrictions on who can give the gift?
Yes, especially for loans sold to Fannie Mae. Quote, the donor must be a relative, fiancé, or domestic partner. And critically, gift funds from interested parties, builders, agents, are prohibited.
No gifts from the builder or realtor. Makes sense. Avoids conflicts of interest.
Exactly. And the big fraud alert here. Misrepresenting a personal loan as a gift is mortgage fraud. Huge red flag for underwriters if they suspect it.
Okay. Third, C, credit history. The question, are they responsible?
Yep. Assessed mainly via that tri-merged credit report, pulling data from Experian, Equifax, and TransUnion.
Tri-merged. Getting all 3. Why is that so critical? What if they don't match?
Good point. It's critical because creditors don't always report to all 3 bureaus. One might show a collection the others miss. You need the full picture. If scores differ, you generally use the middle score for qualifying. Significant discrepancies need investigation, maybe a rapid rescore, a letter of explanation from the borrower.
Understanding payment codes seems vital. The numeric scale.
Yeah, you need to know what each number means instantly. Quote, $0, credit open but not used. $1 or paid on time. $2 will 30 plus days past due. $3 till 60 plus days past due. $4 will is 90 plus days past due. $5 was 120 plus days past due collections. $6 will wage garnishment. $7 is repossession. $8 are charged off. Tells the story quickly.
0 is unused, 1 is perfect, then progressively worse delinquencies up to charge off at 8.
Okay.
And the shorthand codes.
Also useful for quick scans. Things like NR, no record, X, no data. Okay, on time. 30609012 L days late. COL collection. VS, voluntary surrender. RPO, repossession. CO, charge-off. FC, foreclosure. Just recognize the general progression and what they signify.
How long does negative info stay on the report?
Key time frames to know. Most adverse information is kept on a report for no longer than 7 years.
Yeah.
But, quote, bankruptcy information may remain for up to 10 years.
7 years for most things, 10 for bankruptcy.
Got it. And under FCRA, the Fair Credit Reporting Act, remember you need consumer consent and a permissible purpose to pull credit. Can't just run reports randomly.
And the red flags rule helps spot identity theft.
Yeah, through indicators like a bunch of recently opened accounts, using P.O. boxes, tons of inquiries quickly, or a credit history that just doesn't seem to match the consumer's age. Potential signs of fraud.
Okay, fourth and final C, collateral. The property itself. Question, is the asset strong enough?
Right. Is the property adequate security for the loan? Underwriters rely heavily on the appraisal report, the preliminary title report, and any necessary inspections, home inspection, pest inspection, etc.
We talked about manufactured homes earlier. What about converting one to real property, that specific process?
Yes, it's a multi-step process you should know for the exam, turning it from personal property, like a vehicle, into real property,
Mm.
part of the land. Generally involves these steps, quote, 1. The home is permanently attached to real property on a permanent foundation. 2. The certificate of title is surrendered to the county with an affidavit, giving up its vehicle status. 3. The certificate of title is canceled. And finally, 4. An affidavit of a fixture is recorded, affirming the home is now real property and a warranty deed is issued.
Affixed, title surrendered, title canceled, affidavit recorded, deed issued. Okay, that's the process to make it real estate. Crucial for the lender's lien.
Absolutely. Ensures they have a lien on real estate, not just personal property that can depreciate or be moved.
Now, qualifying ratios. The numbers game. Gotta know these formulas and percentages cold for the exam. LTV, first loan to value.
Fundamental. The formula. LTV equals mortgage amount lesser of appraised value or purchase price. Remember, always use the lower of the price or appraisal.
And recall, conventional loans usually need PMI over 80% LTV. FHA goes up to 96.5%, VA potentially 100%.
Correct. Then there's CLTV, combined loan to value, used when there's a second mortgage. Formula. CLTV, first mortgage plus second mortgage. Appraised value.
And that's different from HLTV, high loan to value.
Slightly different. HLTV, or TLTV, total LTV, is used specifically when there's a EELOC, home equity line of credit, involved. You use the maximum line amount, not just the current balance, because the borrower could draw more later. It reflects the total potential encumbrance.
Ah, okay. ALOCs use the max line for HLTV-TLTV. Good distinction. Now, DTI ratios, debt to income. Huge for the exam.
Absolutely critical. Tells the lender how much of your monthly income is already committed to debts.
Two types, right? Front end, back end.
Yep. The front-end ratio, housing ratio, looks only at housing expenses. Formula. Front-end ratio, total housing expense, gross monthly income.
And the typical maxes.
Conventional max is traditionally 28%. FHA max is typically 31%. Key percentages to memorize.
Okay. And the back end ratio, total debt ratio.
Broader picture. Includes all monthly debts, housing, car loans, student loans, credit cards, everything. Formula, back-end ratio, total monthly debts, gross monthly income.
And the max is here. More variation.
Yeah, a bit more complex. Conventional max for manual underwriting is often 36%, but can go up to 45% with strong compensating factors. Fannie Mae's automated systems might allow up to 50%. FHA max is 43%. VA max is 41%.
Wow. Okay. 2836 for traditional conventional, 3143 for FHA, VA at 41 back end. Need to know those numbers.
Definitely. Those DTI thresholds are gatekeepers for qualification.
Lastly, on qualification, lock-in and float agreements.
Quick definition. A lock-in agreement. Rate lock. An agreement by a lender to hold an interest rate and points for a specified time, for 30 to 60 days, while processing a loan, should always be in writing, rate, points, expiration date.
And floating is just the opposite, not locking the rate.
Exactly. You let the rate move with the market until you decide to lock. Or until closing. If you never lock, it's a gamble.
All right, let's shift focus to appraisals.
Yeah.
Valuing the collateral of the property itself. Super important for the lender, right?
Absolutely. Lenders rely heavily on appraisals to ensure the property's value is actually enough to back the loan. If the borrower defaults, the lender needs confidence they can sell the property and recoup their investment.
And it has to be done professionally.
Non-negotiable requirement for almost every mortgage.
Oh.
The appraisal must be prepared by a licensed appraiser. Ensures objectivity, adherence to standards like U.S. Pay.
And it's a key defense against fraud, too.
Huge. The guidelines stress that, quote, overvaluation is a key component of many predatory lending and mortgage fraud schemes. So, a credible independent appraisal is a critical safeguard against artificially inflated values.
Okay, let's talk appraisal forms. Knowing the different types seems like exam fodder. The main one.
Main one, the workhorse, is the Uniform Residential Appraisal Report, UR, or 1004. Quote, is the most common and comprehensive form used for all single-family homes. Think standard house appraisal, that's usually the 1004.
Okay, UR 1004 for single family. What are some others?
You've got forms for specific situations. The 1004 used to update appraisals and report certifications of completion, maybe after repairs are done, or to recertify an older appraisal's value.
Okay, 1004 for updates completion.
The 1007, used for single-family properties, which are intended as investment properties, focuses more on rental income potential.
1007 for single-family rentals.
The 25, used for 2 to 4 unit properties, which are intended as investment properties, expands to small, multi-unit investments.
125 for 2 to 4 unit investments.
And the 1073, used for condominiums, PUDs, and row homes townhouses situated on common ground. Different ownership structures require different forms.
1073 for condos PEs. Got it. These distinctions seem important.
Very high yield for exams, yeah. Knowing which form fits which property type.
And sometimes no full appraisal is needed. A waiver.
Sometimes, yeah. A property inspection waiver, PIW, may be permitted for certain refinances, often lower risk ones with plenty of equity, or based on automated underwriting findings. There are also drive-by appraisals sometimes, less comprehensive.
Okay. Appraisal approaches. There are 3 main ways to determine value.
Correct. And the appraiser actually has to consider all 3, even if one method carries the most weight in the final conclusion. Ensures a well-rounded analysis.
First approach, the most common one.
The sales comparison approach, market approach. This is king for existing single-family homes. It analyzes recent sales of similar nearby properties, the comparables or comps.
How many comps are needed? How recent?
It requires, quote, a minimum of 3 comparable sales settled within the last 12 months. And a key detail. If comps are older than 6 months, they require commentary from the appraiser explaining why they're still relevant and how they were adjusted.
Okay, 3 comps. Within 12 months ideally, justification if over 6 months old. What about adjustments? Proximity, concessions.
Good questions. Guidelines exist for adjustments. Ideally, comps should be within 1 mile. And for sales financing concessions like seller paying buyer's closing costs, these reduce the comparable's effective sale price. There are limits here you must know for the exam.
Limits on seller concessions based on LTV.
Exactly. Quote, LTV 90%, limited to 3% seller concessions, and at the LTV on 90%, limited to 6% seller concessions. Exceeding these caps can be a red flag or impact loan approval. Vital numbers.
3% for high LTV, 6% for lower LTV. Got it. Second approach, cost approach.
Right. The cost approach is commonly used for new home construction. It estimates what it would cost to build a property today, replacement cost, subtracts depreciation, if any, and adds the land value. Logic is, why pay more for an existing home than building a new one?
Makes sense for new builds. Third approach, income.
The income approach. This is primarily used for investment properties. It values the property based on the income it's expected to generate, like rent. If it's a single-family home being used as an investment, the appraiser needs a single-family comparable rental schedule to back up the income valuation.
Okay, sales comparison for existing, cost for new, income for investment. Got it. Now, special rules for higher-priced mortgage loans, HPMLs.
Yes, stricter rules to protect consumers on these potentially riskier loans. The appraisal must be done by a licensed or certified appraiser, conform to U.S. PAPFRIA requirements, this is key, include a physical visit to the interior of the property.
Physical interior visit required for HPMLs. No drive-bys allowed.
Correct. And addressing illegal property flipping, quick buy and resell schemes at inflated prices, there's a rule requiring 2 appraisals under specific conditions. You absolutely must memorize these conditions.
Okay, when are 2 appraisals required for potential flipping?
Condition 1. The seller acquired the home 90 or fewer days prior, and the new purchase price is 10% or more than what the seller paid.
Bought within 90 days, price jumped 10% or more.
Okay. Condition 2.
Condition 2. The seller acquired the home 91 to 180 days prior, and the new purchase price is 20% or more than what the seller paid.
Bought 91 180 days ago, price jumped 20% or more. Got it. Those timeframes and percentages are crucial.
Absolutely critical for the exam, designed specifically to catch rapid, suspicious price inflation.
Okay, let's move into title and insurance. This is all about protecting the investment right for both the borrower and the lender.
Exactly. Making sure ownership is clear and protecting against potential losses. Let's nail down some basic title concepts first. What does title even mean?
Good question. What's the official definition? Quote, having title means that the consumer has the legal right to access and use his or her real property. It's the legal concept of ownership.
And the deed is the proof.
Pretty much. A deed is a legal document that transfers title from one party to another. It's the physical instrument that conveys ownership. Signed, sealed, delivered.
Okay. And there are different title documents we should know. Abstract, commitment, binder.
Yes, important distinctions. A title abstract is like a history report. a detailed summary of the chain of title, showing all recorded transfers, liens, easements affecting the property over time.
Okay, abstract is the history. Commitment.
A title commitment is the title insurance companies promise to issue a policy if certain conditions are met, like paying off old liens. It shows what they will cover and what exceptions exist before closing.
Promise to insure. Binder.
A title binder is different. It's defined as an interim short-term title insurance policy, average 2 years. It provides temporary coverage, often used when a full policy can't be issued immediately, but the lender needs proof of insurance right away.
Okay, abstract, history, commitment, promise, binder, temporary. Got it. And the key legal instruments involved. Deed, mortgage deed of trust, promissory note.
Crucial to know the difference. Deed shows ownership transfer. Mortgage or deed of trust are the security instruments that pledge a borrower's home as collateral. They link the property to the loan.
And the promissory note, that's separate.
Absolutely separate legal function. The note acknowledges a borrower's legal obligation to repay mortgage debt. Think of it this way. Note, IOU, the promise to pay. Mortgage deed of trust, collateral, what happens if you don't pay. They work together but are distinct. Exam loves this distinction.
Note is the debt, mortgage deed of trust is the security.
Okay.
And how do they figure out if the title is clean?
Through a title search? Meticulously examining public records for any issues, easements, existing liens, judgments, breaks in the chain of ownership, anything that could cloud the title. The result of that search is compiled into that title abstract we mentioned.
Right. And we need to distinguish property types again. Real versus personal.
Fundamental difference. Real property. Land and anything that is affixed to the land. Buildings, fences, trees, part of the real estate. Personal property. Anything that is transitory and can be moved. Furniture, cars, etc.
And that manufactured home distinction again.
Yep, bears repeating. Quote, a manufactured mobile home is considered personal property unless it is permanently affixed to land and properly converted to real property for title, tax, and insurance purposes. That conversion process we discussed is what legally turns it into real estate.
Got it. Now liens, claims against the property.
Exactly. Liens are monetary claims against a property that may provide the creditor with the right to foreclose. They give creditors a legal foothold, can be voluntary, like a mortgage the owner agrees to, or involuntary, like a tax lien or a mechanic's lien.
Lien priority. This sounds critical for the exam. What's the #1 rule?
The absolute #1 exception you must remember. Real estate taxes and special assessments generally take priority over all other liens.
Property taxes and assessments, like PAYSIA, get paid first, before anything else.
Always. Even before a first mortgage recorded years earlier. After that major exception, other liens typically follow the order of recording first in time, first in right.
Okay. What if someone has a second mortgage and wants to refinance their first? How does the new first stay in first position?
Through a subordination agreement. It's a document that changes the order of priority between lien holders. The existing second mortgage holder agrees to remain in second position behind the new first mortgage. Without it, the refi lender wouldn't be truly first.
Got it. Subordination changes priority. Title theories and foreclosure, lien versus title theory states.
Important concept. In title theory states, the borrower, grantor, conveys legal title to a trustee via a deed of trust while retaining equitable title. The lender is the beneficiary. Foreclosures are usually non-judicial, faster, because the trustee technically holds title.
Okay. Title theory, trustee holds title, non-judicial foreclosure. Lien in theory.
In lien theory states, the borrower retains both legal and equitable title, and the mortgage serves as a lien against the property. Lender just has a lien, not title. Foreclosure here requires court involvement, a judicial process. Generally slower, more complex.
And intermediary theory states are a mix.
Yep, they blend aspects, often title transfers only upon default. Less common, but exist.
Okay. Required insurance. Protecting against risks. Title insurance.
Title insurance protects against events that may have happened in the past. Undisclosed errors, forged deeds, recording errors, things missed in the title search. It's a one-time premium paid at closing. You need to distinguish lender's policy, protects lender's loan amount, versus owner's policy, protects borrower's equity.
Hazard insurance. Homeowner's insurance.
Yes, required to protect the collateral property from damage like fire, wind, hail, etc. Includes a loss pay clause requiring insurance claims to be made jointly payable to the lender and the homeowner. Protects the lender's interest. If borrower fails to maintain it, lender can get force-placed insurance. Usually pricey and less coverage.
Mortgage insurance. PMI versus MIP. Crucial distinction, right?
Absolutely critical for the exam. Often confused. Private mortgage insurance, PMI. Generally required by lenders on conventional loans when the LTV is higher than 80%. Protects the lender against default, not the borrower.
Conventional loans, LTV 80%. Okay.
MIP.
Mortgage insurance premium, MIP. Required on all FHA loans. Different animal entirely. Includes an upfront MIP collected on all FHA loans in addition to an annual MIP collected monthly. Know the triggers, LTV for PMI, all FHA loans for MIP, and payment structure, upfront plus annual for MIP. Guaranteed exam questions here.
PMI for conventional, 80% LTV, MIP for all FHA, upfront plus annual. Lastly, flood insurance.
Required for properties in a special flood hazard area, SFHA, to protect the collateral property. SFHAs are defined as areas with a 1% chance of flooding in any given year, also called the 100-year flood.
1% annual chance was SFHA equal 100-year floodplain. Which zones require it?
Memorize this. Flood zones designated with an A or V prefix are SFHAs and require mandatory flood insurance. A and V zones, mandatory flood insurance. What about other zones like B, C, D, X?
D means undetermined risk, insurance available but not mandatory. B, C, and X are generally considered lower risk outside the mandatory purchase areas, though insurance might still be a good idea.
Okay, we're nearing the finish line of the loan process. Closing, funding, and post-closing. This is where it all comes together. The closing agent plays a big role here.
Huge role. Often an attorney or title company rep. They coordinate everything, verify numbers, check IDs, explain documents, ensure everything is signed correctly, and handle the money disbursement.
And the main closing document depends on the state. Mortgage or deed of trust.
Exactly. Mortgage and lien theory states, deed of trust and title theory states, reflecting those legal differences we discussed.
What if someone can't physically be at closing? Power of attorney, POA.
Yes, POAs are used. But for Fannie Mae loans, there are rules. The POA must be valid, notarized, and reference the property address. Specificity is key.
And there's a rule about who cannot act as the attorney, in fact. This sounds like an exam question.
Definitely testable. Avoids conflicts of interest. Pay close attention. The attorney, in fact, may not be the loan originator, lender, title company employee, or real estate agent with a financial interest in the transaction. Basically, no one who stands to gain financially from the deal itself can hold the POA.
Okay, no interested parties as POA. Got it. What about the right to rescind? That cooling off period.
Crucial time frame, often misunderstood. Quote, for refinance transactions on a principal residence, the loan will fund after a 3-business-day rescission period.
3 business days, only for refinances on a principal residence, not purchases.
Correct. Gives the owner-occupant borrower a chance to cancel the refi without penalty after signing. Doesn't apply to purchases or investment properties.
Yeah.
Business days include Saturday, but not Sunday or federal holidays.
Good clarification. Settlement types, wet versus dry.
Yeah, how the money moves isn't always the same. Wet settlement. This is most common. Parties execute documents and funds are dispersed immediately afterward. Sign and get paid right away.
Okay, wet immediate funds, dry.
Dry settlement. Parties execute documents, but funds are not dispersed until certain conditions, like recording the mortgage, are satisfied. Might happen in states where recording takes time. Signed today, money moves later once the lien is officially recorded.
And table funding. That's mainly for brokers.
Often, yeah. Table funding. A broker originates and closes a loan in their own name, but at the time of closing, the loan is transferred to a lender who provides the funds for disbursement. Broker handles the closing, but a larger lender actually wires the money.
Okay. Regardless of type, funding involves the lender wiring money.
Typically, yes. Lender wires funds to the closing agent, who then pays everyone, seller, old lender, realtor, title company, etc., once all conditions are met and documents are signed.
Okay, closing done. Post-closing. What happens after the loan is paid off?
In title theory states, there's reconveyance. Quote, once the loan is repaid, the trustee reconveys legal title back to the homeowner, and the deed of trust is marked paid in full or canceled on the public record. Officially releases the lien and clears the title. Lien theory states use a satisfaction or release document.
And loan servicing, that's who you pay each month.
Exactly. Servicing is handled by the company responsible for accepting payments, dispersing funds from escrow for taxes and insurance, managing delinquent accounts, and helping with loss mitigation. They manage the day-to-day of the loan.
What if servicing gets transferred? Rules there.
Yes. Borrower protections. Timeframes for the exam. The servicer must notify the borrower at least 15 days before the effective date of the transfer, and a grace period. If the borrower makes a timely payment to the old servicer within 60 days of the transfer, they cannot be penalized. Prevents issues during the handover.
15-day notice, 60-day grace period for payments. Good to know.
Yeah.
Finally, electronic closings, e-closings.
The modern way. But key point. Under the Federal e-Sign Act, borrowers must give active consent to participate in an electronic process. Can't force it on them.
Consent is key, and there are hybrid versions.
Yep, hybrid closings mix wet signatures offered for the note with e-signatures for other docs. Full e-closings aim for everything digital, including an e-note.
What about electronic notarization, RON?
Remote online notarization. Here's a tricky detail for the exam. The seigneurs can be anywhere, but the notary must be commissioned in the same state where the property is located. Notary's location commission matters, not necessarily the borrower's physical location.
Notary must be commissioned in the property state. Got it. How do they verify ID remotely?
Robust methods are required. Quote, may include credible witnesses, personal knowledge, or a multi-part process consisting of remote ID presentation, credential analysis, and knowledge-based authentication, KBA. Multiple layers to ensure security.
And e-recording. Is that universal?
No, depends entirely on the county recording office. If the county doesn't accept electronic documents, even a full e-closing needs a paper step for recording the deed mortgage. Often necessitates a hybrid closing.
Okay, let's really zero in on the key federal regulations and disclosures. Compliance is everything for the SAFE exam, right? Knowing the rules, the why behind them, the timings.
Absolutely vital for a perfect score and just for staying out of trouble in your career. Let's start with the big ones under TILA. The ability to repay, ATR, and qualified mortgage QM rules.
ATR, what's the core principle?
The core principle, quote, requires lenders to make a reasonable good faith determination that a consumer has a reasonable ability to repay a loan. Based on verified info, not just hope, prevents setting borrowers up to fail.
Applies to most mortgages. Are there exceptions?
Applies to most closed-end residential mortgages. But yes, crucial exemptions you must know for the exam. ATR doesn't apply to, quote, open-end home equity plans, HELOCs, reverse mortgages, bridge loans, 12 months, construction loans, and loans made by a housing finance agency.
Okay, HELOCs, reverse, short bridge loans, construction, HFA loans are exempt from ATR. Got it. How does a lender determine ATR? Specific factors.
Yes, 7 specific underwriting factors they must consider. Memorize this list. Quote, 1. Current and reasonably expected income or assets. 2. Employment status. 3. The consumer's credit history. 4. The consumer's current debt obligations, including alimony child support. 5. The consumer's monthly mortgage-related obligations for the loan sought. 6. Obligations for any simultaneous loans secured by the same property. And 7. The consumer's monthly debt-to-income ratio or residual income. Comprehensive look.
Income, employment, credit, debt, new PITI, other liens on property, DTI residual income. Okay, that's the ATR checklist. Now, qualified mortgages, QMs, these are safer loans.
Generally considered safer, yeah. They offer lenders certain legal protections if the borrower defaults, assuming ATR was met. But to be a QM, the loan cannot have certain risky features. These prohibitions are critical for the exam.
What features are prohibited in a QM loan?
Okay, a QM loan, quote, may not have a term of more than 30 years. No 40-year QMs. Also no, quote, negative amortization, interest-only payments, or balloon payments with limited exceptions. Features that can cause payment shock are generally out. And finally, no, quote, points and fees that exceed the set cap. Generally, this cap is 3% of the loan amount.
30-year max term, no neg amio balloons mostly. Points fees capped usually at 3%. Got it. Any difference in how payments are calculated for QM versus non-QM?
Yes, a subtle but important distinction. Quote, QM payment calculations must be based on the maximum interest rate that may apply during the first 5 years of the loan term. Conservative approach. But for non-QM payment calculations, must be based on the fully indexed rate, which takes into account potential rate changes for the entire loan term. Important for disclosures and understanding true cost.
Okay, let's switch to RESPA, Real Estate Settlement Procedures Act. Disclosures and timings are key here. Your home loan toolkit.
That booklet is, quote, required for purchase transactions and due 3 business days after the completion of a loan application. Early info for purchase borrowers.
List of homeownership counseling organizations.
Also early. Quote, due no later than 3 business days after a completed application is received. Points borrowers towards independent advice.
Affiliated business arrangement. AFBA. Disclosure. When's that due?
Critical timing here. Due at the time of referring a loan applicant to a service provider where the referrer has an ownership interest. Immediate disclosure is required.
Initial escrow account statement.
Shows estimated escrow payments for the year. Quote, due 45 days after closing, often provided at the time of closing.
Annual escrow account statement.
Reviews the past year, projects the next. Quote, due annually. Makes sense.
Escrow closing notice, when is that needed?
If an escrow account is being closed, timing depends. Do 3 business days before closing if requested by the borrower, or no later than 30 business days before if canceled by the creditor servicer.
Mortgage servicing disclosure statement tells them who will service.
Yes, discloses intent to service or transfer. Quote, do 3 business days after completion of a loan application. This disclosure now appears on page 3 of the loan estimate, integrated now.
And the servicing transfer statement we mentioned before?
Confirms an actual transfer. Quote, due 15 days prior to the effective date of the transfer. Now, TILA and TRIDE disclosures, Truth in Lending Act, even more critical timings and triggers here. The loan estimate, LE.
The LE, that dual timing rule, right.
Exactly. Quote, must be delivered or placed in the mail no more than 3 business days after receiving a loan application and no later than 7 business days prior to consummation. Can't close too soon after issuing it.
3 days after apps, 7 days before closing. Got it. The closing disclosure CD.
The final cost breakdown. Quote, do no later than 3 business days prior to consummation. Gives the borrower time to review final figures.
And changes can trigger a new waiting period.
Yes, that's crucial. Redisclosure restarts the 3-day clock if, quote, the APR varies beyond tolerance, a prepayment penalty is added, or the loan product changes. Significant changes require a new review period.
Okay. The charm booklet for ARMs.
Consumer Handbook on Adjustable Rate Mortgages. Quote, within 3 business days of application for all ARMs, explains ARM risks early.
When your home is on the line, booklet for ALOS.
Yes, specific to ELSUs. Quote, due at the time an application is provided.
Redisclosure of APR, those specific percentage tolerances. Exam loves these numbers.
Absolutely. Memorize these. For a regular transaction, most fixed-rate loans, redisclosure is required. Anytime the APR varies by more than 1/8 of 1%, 0.125%, for an irregular transaction like ARMs or construction loans, it is required if the APR varies by more than 1/4 of 1%.
0.125% for regular, 0.250% for irregular transactions. Tiny tolerances trigger redisclosure.
Okay. Initial rate change disclosure for ARMs. Gives advance warning. Big warning window. Quote, at least 210 days, but no more than 240 days before the initial rate change occurs. Plenty of time to prepare.
And then notice of right to rescind again. When is it due?
Quote, due at the time of closing in transactions that are not related to a home purchase or to a refinance with the lender who made the loan being refinanced. Key exceptions. No right to rescind on purchases or refis with the current lender.
Got it. Okay, last batch, other key disclosures. So see the act and timing. Balloon payment notice.
Required by HUIPA for high-cost loans. Quote, at least 3 business days prior to closing.
Notice regarding insurance premiums. Also HUIPA.
Yes, for refis if optional insurance is financed. Quote, due at the time the disclosure is provided. Warning, it increases the loan amount.
Notice of right to receive appraisal report.
Ensures borrower access. Quote, due no later than 3 business days after a creditor receives an application for a first loan.
Notice regarding monitoring programs. EFOA.
Yes, Equal Credit Opportunity Act. Required, quote, when collecting demographic info for fair lending monitoring. Explains why it's asked.
Notice of action taken. Credit decision notice. ECFOA again.
Yes, informs applicant of approval denial counteroffer. Quote, no later than 30 days after the receipt of a loan application.
Notice of right to cancel PMI, Homeowners Protection Act.
Right, HPA. Informs about canceling private mortgage insurance. Quote, due at closing and required in annual disclosures.
Notice of right to receive credit score. FACTA.
Fair and Accurate Credit Transactions Act empowers consumers regarding their credit, quote, due during the loan transaction.
And Notice of right to financial privacy.
GLB Act.
Graham-Leach-Bliley Act. Protects financial info, quote, due at the time of establishing a customer relationship, explains privacy policy and opt-out rights.
All right, let's crunch some numbers. Financial calculations. This section is all about the math behind the mortgage. Got to get comfortable with these formulas for the exam. Definitely. Don't let them intimidate you. They're pretty logical once you break them down. First, the absolute basic rule for any percentage calculation.
Convert the percentage to a decimal.
Always. Quote, all calculations should convert percentages to decimals by moving the decimal 2 positions to the left. For example, 6 positions to the left, 6 position 0.06. Foundational step.
Okay. Income calculations, hourly workers. How do we get to monthly?
Multi-step process. Base rate times hours gives weekly base. OT rate times OT hours gives weekly OT. Add base plus OT for total weekly. Multiply weekly total bi-weeks worked, usually 52, for annual. Divide annual by 12 for monthly.
Okay, weekly to annual, annual to monthly, biweekly salary. Paid every 2 weeks.
Simpler. Quote, take the bi-weekly salary x 26, since there are 26 pay periods, 812 to get the monthly income. Correctly averages it out.
And self-employed or commission income, average.
Generally, yes. Quote, averaged over 2 years. Formula, year 1 income plus year 2 income. E24 gives the monthly income, smooths out the ups and downs.
Okay. Interest calculations, periodic rate, like for monthly payments.
Simple division. Quote, periodic rate equals annual rate number of payments in a year. So 6% annual 12 months equals 0.5% monthly periodic rate, or 0.005 as a decimal.
And the interest part of one payment, periodic interest.
Use that periodic rate. Quote, periodic interest, periodic rate x loan balance, tells you how much interest accrued that specific period.
Interest per diem, daily interest, for closing prorations.
Yep. 2 steps. Annual interest rate x loan balance, then the daily interest, annual interest 365 or 360 depending on lender requirement. 365 is more common now for mortgages.
Okay. Payment calculations, PITI. Principal, interest, taxes, insurance. P&I comes from a calculator.
Yeah, the principal and interest payment is complex, usually derived from loan amortization formulas or a financial calculator, but you need to calculate the T&I components.
Monthly taxes.
Easy one. Quote, monthly taxes, annual property taxes 12.
Monthly mortgage insurance, PMI or MIP.
2 steps again. Quote, annual PMI loan amount X mortgage insurance rate, then monthly PMI, annual PMI 12.
And the total PITI payment, just add them up.
Exactly. Total PI payment, PITI, P&I payment, plus monthly taxes, plus monthly homeowner's insurance, plus monthly PMI. That's the borrower's full housing expense.
Okay, quick recap on loan and value calculations. Minimum down payment.
Simple percentage. Quote, down payment, purchase price, X. Down payment percent.
LTV again.
Loan to value. Quote, LTV will loan amount lesser of the property value or purchase price. Always use the lower value.
And CLTV. Combined loan to value.
Accounts for all liens. First find, total encumbrance, first loan balance plus second loan balance plus all other lien balances. Then CLTV, total encumbrance lesser of the property value or purchase price.
Okay. DTI ratios, again, just the formulas. Front-end housing.
Quote, front-end ratio, housing expense income. Just PITI divided by gross monthly income.
Back-end total debt.
Quote, back-end ratio, total monthly debts income. All debts, including PITI, divided by gross monthly income. And remember that revolving debt rule.
Ah, yes, the 5% rule for credit cards.
Crucial for exam calculations. Quote, unless there is evidence of a higher minimum payment, Freddie Mac and many other investors require the use of a 5% minimum payment on revolving debt. Use 5% of the balance, not the potentially tiny minimum payment shown on the statement. Big impact on DTI.
Okay, 5% of balance for revolving debt DTI calc. Got it. Discount points versus buy downs. Points first.
Discount points. Fees paid by the borrower to permanently reduce the note rate of a loan. Prepaid interest. End quote. 1 point is equal to 1% of the loan amount. Formula. 1 point use a loan amount by 0.01.
And temporary buy downs are different.
Totally different function. Offsets payments for a short time, reduces the payment rate, but crucially, quote, not the note rate. The underlying interest rate doesn't change. Funds just subsidize initial payments. Key distinction.
Okay. Lastly, ARM calculations, fully indexed rate.
The rate after any intro period ends. A central formula. Fully indexed rate, index plus margin. Index fluctuates, margin is fixed.
Common indices, CO high, SOFR.
Yeah, those are common benchmarks. ARMs also have caps, periodic rate caps, limit per adjustment, and lifetime caps, overall limit. And a critical point about payment caps. Payment caps, where the payment amount is limited even if rates rise sharply, can lead to negative amortization, a feature that is no longer allowed for HEPA loans and qualified ARMs. Big consumer protection prevents loan balances from increasing even when payments are made on safer QM loans. Hashtag tag outro.
Wow. Okay, that was a lot. We've covered an absolutely immense amount of ground today.
We really did. From the very first step, the application, its details.
Right, through underwriting, the 4 C's, appraisals, title, insurance.
Closing, funding, post-closing, all those critical federal regulations, disclosures,
The
timing.
math. Can't forget the math.
Definitely not. And look, mastering these specific details, these definitions, these distinctions, that's absolutely the key to hitting that perfect 100 on your SAFE exam.
Yeah, that textbook fidelity we talked about.
Exactly. We encourage you, really review these highlighted points, practice with the precise definitions we shared. It's not just about memorizing, it's about truly understanding the why and how.
So what does this all mean for you listening right now? It means your role as a loan officer. It's pivotal. You're guiding borrowers through this incredibly complex landscape
Mm-hmm.
and having this deep, foundational, precise knowledge. It isn't just about passing a test, it's about being that indispensable expert in your field.
It really is. Ensuring borrower understanding and regulatory compliance every single step. Your ability to navigate this calmly, confidently, explain it clearly, that makes all the difference.
Every one of these details, from a form number to a disclosure timing to a calculation method, it all contributes to a smooth, compliant, successful loan.
Your mastery here translates directly into competence and confidence, not just on exam day, but every day you work with your clients.
So go forth, study hard, use these insights, and just walk into that safe exam with confidence. You absolutely got this.
You do. Thanks for diving deep with us.
On the deep dive.